The year 2025 was a paradox. Global economic rules were upended, and yet, against all odds, the world's financial systems seemed to defy gravity. As old certainties faded, new patterns emerged, challenging the very foundations of what experts thought they knew. Yet markets soared with optimism. Investors, fueled by a mix of hope and bold speculation, pushed indices to record highs, creating an atmosphere of exuberance that rippled through trading floors from New York to Shanghai. Despite predictions of turmoil from geopolitical instability and radical policy shifts, the anticipated downturn never arrived. Headlines warned of looming crises, but the world's economies seemed to shrug off each new threat with surprising ease. Instead, the global economy showed unexpected resilience, with stock markets reaching new highs and growth accelerating in key regions. Cities buzzed with renewed energy, and industries adapted quickly to shifting landscapes, driving innovation and expansion. This disconnect between market euphoria and underlying risks left experts puzzled. Economists debated whether the boom was built on solid ground, or if it was merely a mirage, destined to fade as quickly as it appeared. Was this strength a sign of true economic health, or just a temporary reprieve before a reckoning? Analysts pored over data, searching for clues, while business leaders weighed cautious optimism against the possibility of hidden vulnerabilities. The robust growth emboldened some leaders, while others grew uneasy about the gap between sentiment and reality. Political speeches celebrated the boom, but behind closed doors, concerns simmered about the sustainability of such rapid gains. Navigating these uncharted waters, the world enjoyed relief, but remained wary of what might come next. Trade continued to flow, and businesses seized opportunities, but caution lingered in the air, as if everyone sensed that the calm might not last. The challenges hadn't vanished. They were simply overshadowed by the dazzling performance of the markets. Beneath the surface, unresolved issues and potential shocks still lurked, waiting for their moment. 2025 tested the system, but the real test was still ahead. The resilience on display was remarkable, but it raised a crucial question. How long could this momentum truly last? The resilience of the year offered a brief window to prepare for the uncertainties of 2026. As the sun rose on a new era, the world stood at a crossroads, grateful for the reprieve, but acutely aware that the next chapter was unwritten, and anything could happen. At the heart of 2025's upheaval was a bold shift in U.S. policy. The administration's aggressive tariffs and retreat from global institutions like the G20 signaled a break from decades of international cooperation. America's new doctrine set its own rules, leaving others to adapt or fall behind. Even the Federal Reserve's independence was questioned, injecting new uncertainty into markets. The U.S., once the architect of open markets, became the chief disruptor, favoring protectionism and bilateral deals. While immediate fallout was limited, the long-term consequences of this new approach were profound. The world was left to wonder what would fill the void left by the old order. As the U.S. redrew the global economic map, the rest of the world faced its own storms. Geopolitical crises, from conflicts to resource strains, created persistent instability and economic uncertainty. Meanwhile, record-high debt levels across governments, corporations, and households made the system fragile. One shock could trigger a cascade of defaults. Central banks' efforts to sustain growth only added to the debt and sometimes fueled inflation. The world was walking a tightrope, balancing growth against mounting risks. These headwinds, conflict, debt, and policy side effects, remained ever-present threats. The economy's continued growth didn't erase these dangers. They lurked beneath the surface. The upbeat markets did little to mask the minefield just below. Amid global anxieties and economic uncertainty, a speculative frenzy erupted in the tech sector, capturing the imagination of investors and the public alike. The world watched as fortunes were made overnight, and the promise of artificial intelligence seemed to offer limitless potential. The AI gold rush saw investors pour trillions into startups, often ignoring fundamentals in favor of hype. Money flowed freely, with venture capitalists and even everyday people eager to get a piece of the next big thing. Startups with little more than a pitch deck and a dream found themselves flush with cash, as the fear of missing out drove valuations to dizzying heights. FOMO replaced caution, echoing past bubbles like the dot-com era and Dutch tulip mania. The lessons of history seemed forgotten as speculation took center stage, and rational analysis was often drowned out by the roar of excitement and the promise of easy riches. The sector's meteoric rise diverted capital from other vital industries and strained energy resources. Traditional sectors struggled to compete for attention and funding, while the massive energy demands of AI infrastructure put pressure on power grids and raised concerns about sustainability. While AI's promise was real, the bubble's risks were ignored by many. Warnings from analysts and industry veterans were brushed aside, as optimism and greed fueled a relentless upward march. The tech world seemed detached from the broader economic reality, driven by momentum rather than value. As celebrations continued in Silicon Valley, small businesses and traditional industries faced growing challenges, highlighting a widening disconnect. A sudden collapse in AI valuations could trigger a wider downturn, sending shockwaves through global markets and affecting millions far beyond the tech sector. The spectacle was thrilling, but the stakes for the global economy were enormous. Policymakers and investors alike watched nervously, aware that the consequences of a crash could be severe and far-reaching. The question wasn't if a correction would come, but when. As the clock ticked down, the world braced for the inevitable reckoning, hoping that lessons from the past would finally be heeded. Despite dire forecasts and widespread anxiety, 2025 delivered a stunning economic boom that caught nearly everyone off guard. Headlines blared about growth, and the world watched in disbelief as the numbers kept climbing. The U.S. economy, long predicted to stumble, instead defied expectations, posting robust growth and silencing critics of its disruptive policies. Wall Street buzzed with excitement as investors scrambled to get in on the action. Globally, recession was avoided as many nations chose not to escalate trade wars, keeping commerce alive. International cooperation, though fragile, helped maintain the flow of goods and services, preventing a feared economic downturn. Even countries with tense relationships found common ground in the pursuit of prosperity, realizing that stability benefited all. Stock markets soared worldwide, fueled by strong earnings, a wave of technological innovation, and a surge of optimism around artificial intelligence. Investors poured money into tech firms, betting on a future transformed by automation and data. Investor confidence created a powerful feedback loop. Rising markets boosted consumer spending, which in turn fueled more growth. People felt wealthier, and that optimism spilled over into everyday life. For many, it felt like a golden age, with bustling cities and vibrant communities, even as warning signs persisted beneath the surface. The paradox was clear. Booming data clashed with underlying risks and instability. Some experts warned that the numbers didn't tell the whole story. How could markets thrive amid such uncertainty? Many analysts struggled to explain the disconnect between soaring markets and persistent vulnerabilities. The boom was real, but its foundations were fragile. Underneath the celebration, cracks began to show. Debt levels were rising, and some sectors looked dangerously overextended. Momentum and sentiment, not fundamentals, drove the party. The excitement was contagious, but it masked deeper issues that few wanted to confront. Few could explain why it hadn't ended, and as the world celebrated, a sense of unease lingered. Was this prosperity built to last, or just a fleeting illusion? The strength of 2025 bred a dangerous complacency. Policymakers mistook luck for strategy, believing old rules no longer applied. But the risks, debt, geopolitical flashpoints, and the AI bubble, remained unresolved, even growing. The system's capacity to absorb shocks is finite. Assuming endless resilience is wishful thinking. The lack of immediate pain from protectionism may tempt leaders to double down, but consequences often come later. Trade disruptions and eroding alliances could hit hard in 2026. The lesson isn't triumph, but warning. The world bought time, not immunity. Complacency now would be a historic mistake. The resilience of 2025 should be a wake-up call. The challenges ahead demand a more thoughtful, deliberate approach. To face 2026, the world needs a shift from quick fixes to lasting solutions. Debt-fueled spending and protectionist tariffs are temporary painkillers, not cures. True stability requires deep structural reforms, transparent regulations, fairer tax codes, and fiscal responsibility. Governments must prioritize investments in infrastructure, education, and research for long-term growth. Trade policy should focus on modern agreements, not blunt tariffs. The private sector must invest in people, sustainability, and innovation. not just chase the latest trend. The AI frenzy showed the dangers of hype-driven capital. A disciplined, forward-looking approach is essential for lasting prosperity. Only real reform can build a resilient economy. To avoid crisis in 2026, governments and corporations need a new playbook, one built on resilience and foresight. Governments must embrace fiscal responsibility, end the era of limitless debt, and restore the independence of key institutions. Stepping back from economic nationalism and re-engaging with global institutions is vital. Updating international rules together is smarter than retreating behind tariff walls. Corporations must shift from financial engineering to real value creation, investing in core business, employees, and innovation. Preparing workforces for AI and diversifying supply chains are key. Both sectors must assess risks beyond the immediate horizon. Proactive measures now are the best insurance against future shocks. Today's prosperity must not become tomorrow's crisis. The key to navigating 2026 and beyond is adaptability. The world is changing fast, technologically, geopolitically, and socially. Old strategies no longer guarantee stability or growth. The lesson from the New Economy Forum: those who adapt will thrive, those who don't will fall behind. Governments must embrace pragmatism, experiment with new policies, and build agile institutions. Businesses need a culture of continuous learning, innovation, and responsiveness to change. The most successful will be nimble, not necessarily the biggest. The time bought by 2025 is running out. Complacency is not an option. Building a resilient future is everyone's responsibility, from policymakers to citizens. The future isn't to be predicted, it's to be prepared for.